Well, good morning, everybody, and welcome to RSM Australia's first webinar in the Business Essentials series, which will focus on end of financial year tax and superannuation planning. The Business Essentials series looks at different contemporary issues for business owners, and our upcoming topics are going to also include cybersecurity, data analytics, and cash flow management. I would firstly like to acknowledge the traditional owners of the different lands on which we gather today and pay our respects to the elders, past, present, and emerging. As we stand at the threshold of a new financial year, it's imperative for business owners or managers like yourselves joining us today on the session to strategise and prepare for upcoming tax obligations. Today's webinar will aim to equip you with the necessary updates, insights, practical tips and approaches to navigate this complex terrain effectively. Our session will be co-presented by Belinda Crowley, Principal in our Tax Services team, as well as Lauren Taylor, Principal in our Business Advisory team, who will cover off on all things superannuation. Lauren specialises in superannuation and has kindly stepped in for Katie Timms, who was scheduled to present, but unfortunately lost her voice this week and is unable to do so. However, Katie is online with us today and will be monitoring the questions and will be able to submit her input and thoughts through that channel. If you do have any questions for our presenters today, please feel free to use the chat or the Q&A box to submit these, and we will endeavour to answer them towards the end of the presentation. If we happen to run out of time, we'll take these offline and respond to you directly. We are also recording this session and will provide a link to our post-event communication, which will also include a short feedback survey, giving you an opportunity to have your say on today's presentation and put forward any suggestions for additional topics or interests that we can consider for upcoming events. I would now like to hand over to Belinda Crowley to commence her presentation.
Thanks, Galina, and thank you all for your attendance today. I appreciate that the lead up to 30 June is a really busy time for everyone. So hopefully today's session is quite valuable for you and you take something away. Just to outline quickly our agenda, I'm going to start with a really quick recap of the key budget measures that impact individuals and businesses, and then followed by an update of the ATO's focus areas for 2024. I've also included here some of the findings from the top 500 and next 5,000 assurance programs, which are aimed at the private sector, to provide an idea of what the ATO is seeing at the moment. I'll then run through a few of the key items to consider leading up to year end, as well as some of the recent judicial decisions that impact into that. Lauren's going to speak about a few year-end basics in relation to superannuation and then cover off on some of the new super measures that are coming in, as well as what to expect going forward. And she'll also spend a little bit of time discussing Division 296 tax. So I'll begin with the income tax component. As mentioned, please feel free to put any questions into the chat and I'll try and answer them as I go along, but if not, come back to them at the end of the presentation. So firstly, as you know, the budget was handed down in May, and I'll quickly begin by recapping that. The headline grabber was, of course, the stage 3 tax cuts, which were not as originally planned as under the Morrison government. However, they're targeted to provide much needed cost of living pressure relief. I've included these cuts on the slide there, and as you can see, the savings go up to around $4,500 per person, and they depend on your marginal rates. Other cost of living measures for individuals in the budget included a reduction in medication prices, the energy bill reductions, which were on top of the state government grants, and as well as some student loan relief. On the business front, there was some electricity relief for SMEs, and that depends on your annual electricity consumption, not on size. There's also a removal of import tariffs on many household goods such as toothbrushes, tools, fridges. There was some cybersecurity support, mental health, and also some support to help people understand the new workplace health and safety laws. And all of those measures are particularly targeted at SMEs. The mandatory notification period for BAS refund retention has now been increased to 30 days, so that was 14 days. All that means is that the ATO now can hold on to your refund for much longer. And it's a clear result of the sort of the scam and fraudulent activity that the ATO is facing in that area at the moment. Unfortunately, it's the honest businesses that are paying the price for that. The other point to note there is the ever-increasing funding for compliance activity. And that provides the ATO with fairly good bang for buck, which is why they keep investing in that. I'll also quickly mention here the increased data matching capability of the ATO. From 2024, the ATO is also going to data match investment loan interest, insurance policies, income protection premiums, and they'll also have a lot of access to information on the sharing economy. So they're going to get information from Airbnb and the taxi ride company, the rideshare companies and those types of things. Just quickly, the instant asset write-off, which is in one day and out the next. So at the moment, it's proposed to be extended out to 30 June 2025. The legislation was tabled last week, and as far as I am aware, hasn't yet passed, but hopefully will do so in the next few weeks. Keep in mind, this now only applies, however, to businesses with turnover below 10 million, and it's capped at assets costing less than $20,000. Note that there's also some pooling requirements that come along with opting in to the instant asset write-off, so you need to be aware of them. Also, there's a small business energy incentive that's available up until 30 June 24. And that incentive provides a 20% deduction uplift for spending which supports electrification and more efficient energy use. That uplift is available for businesses with turnover below 50 million. So certainly if you're in that category and that you've invested in energy efficiency during the past year, then make a note of that when providing your information through to your advisor. The additional deduction is capped at 20,000, however, and so the tax benefit is a bit over 6,000. Moving now to the ATO's current focus areas, which they publish each year. The key ones to mention there are the focus on private use. We've noticed out of the top 500 and the next 5,000 programs, which I'll talk to shortly, that this is a real focus area from the ATO. It obviously has implications for Div 7A, where you're privately using company assets, but also deductions aren't available to the extent that something is used for private use. So the ATO is looking there at the apportionment. The other key element there is record keeping, which again is coming through from these assurance programs. There's also been quite a few judicial decisions in the past year which have turned almost wholly on the availability of evidence. So I can't emphasise enough how important it is to make sure that you have documentation in place to support transactions, particularly related party ones. So loans, where if you're charging a management fee to a related entity, lease agreements is a big one that often goes missed. And the other area that they flagged with the documentation is GST, particularly related party transactions. Just a few comments on what we're actually seeing practically. There's definitely been a tightening on late lodgements and payments, so the ATO letters are coming out a lot quicker. There's also been less willingness to grant extensions, so if you've been relying on them on the past, probably don't rely on them going forward. And at the same time that the ATO is increasing its expectations of taxpayers, they are certainly slowing down. So we're seeing really long processing times on forms, which is causing a lot of delays and probably unnecessary costs as well. Just on the right there, there's a graphic around the ATO's random inquiries of small business programs. And the ATO uses that information to estimate the small business tax gap. It shows reasonably good compliance, but there's still around 38% of taxpayers that are either making mistakes or engaging in fraudulent activity, which indicates that the ATO is probably going to keep going in this area. Section 100A continues to be a key focus. And the ATO's focus here is on arrangements where a trust distributes to a beneficiary, but that beneficiary doesn't actually get the funds. And the key point of attack here has been distributions to children, particularly adult children, where those funds distributed don't actually make their way to the child. During the year, there was some new guidance around the exception for normal family dealings, which I won't go into detail, but certainly where you have trust distributions that are going out to family members and the cash isn't flowing from that, further short thought should be given. Finally, I'll just make a quick comment around the international side, and I appreciate it's not relevant to everyone, but this is a huge focus area of the ATO at the moment, and also the government. So to the extent that your group has international operations, certainly I'd recommend taking some time to understand the activity in that space. 2 points to mention in particular. Firstly, the withholding tax. So this applies to any payment of interest, dividend, insurance or royalties to a non-resident. So if you're making those payments and not withholding, certainly seek some additional advice. Note that withholding applies to payments, to any payment. It doesn't have to just be to a related party. The other thing to mention there is the ATO's increasing focus on royalties, where they've certainly expanded what I'll term the conventional definition of that term. So any payments for things like distribution rights, any payment that allows you to use trademarks or IP of another company is certainly a red flag. And again, if you have any concerns there, I'd recommend speaking with your advisor. The second point that I've mentioned there is the new thin capitalisation rules. So these apply to debt deductions and they've been completely rewritten. So if you have debt deductions and your group does have either foreign owners or foreign subsidiaries, then certainly I'd speak with someone to make sure you're aware of how those changes might impact you. Next up, just quickly sharing the findings out of the top 500 and next 5,000 reviews, mainly because the ATO sort of uses them to flow down through its other compliance programs when it's looking at taxpayers and risks. For those that aren't familiar with these programs, the ATO conducts some fairly broad-ranging reviews of groups, which depends on their characteristics. So for the top 500 group, the key thresholds for entry into that are turnover of greater than 250 million or assets of over 500 million. So this is the real top of the private groups. And the next 5,000 program looks at individuals who together with their associates control wealth of over 50 million. A key component of the reviews is tax governance, and looking at the tax governance framework of the taxpayer, with the emphasis being that it's fit for purpose and also that it's acted on in practice. So it's no good just having a document there if it's not lived. Certainly if you're part of the programs or if you're coming close to those thresholds, it's worth thinking about implementing a tax governance framework because it really changes the frame of the conversation with the ATO where you're able to produce that. They have a lot higher sort of off the bat assurance. So hopefully the idea being that they'll dig not so deeply. Other things that they continue to be concerned around are CGT, particularly the characterisation of assets on revenue or capital account, gains on disposals of assets to related party. So really, they want to see valuation now, and they've produced some guidelines which set out what their expectations there are. Div 7A is another one, particularly the minimum yearly repayments on loans and also the use of company property, which I mentioned earlier. Some of the other areas that were flagged were claiming franking offsets on trust distributions where there's no family trust election in place, and also 100A, which I referred to earlier. A lack of documentation, again, that really comes through and is a real focus area of the ATO. And the other area that was singled out was GST, particularly where taxpayers are unable to explain the differences between sales reported in their BAS and the sales that they're reporting in their tax return. So it's probably worthwhile performing a reconciliation process at year end just to identify any gaps to make sure that you can explain them in the event that the ATO asks. The related party treatment for GST purposes was also noted. So where you have transactions between related parties and you're not raising invoices or charging GST on those was another area that concerned the ATO. So I guess now that we've sort of looked at what the ATO's been looking at, a few pointers, I guess, coming into the year end to be aware of. The first there is to pay the super liabilities before 30 June. Lauren will obviously talk about that more. Bonuses, if your group is a group that pays bonuses, the amount's only deductible at 30 June if it's definitively committed to at that point. So that won't be the case where there's an element of discretion to the bonus, or say the bonus relies on a board resolution being passed. So if you are certain that the bonus is going to be paid for the year, then it may be worthwhile ensuring that it is committed to, particularly if there's no contractual obligation to pay it. So ways of doing this, I guess, will be by a board minute declaring the bonus, or also directly notifying the employee that they are entitled to the amount. Note that it doesn't have to actually be paid by 30 June. It just needs to be committed to. If you have large quantities of stock, certainly undertaking a stock take to ensure the stock on hand is correctly reflected will assist. Accounting for your obsolete stock. There's a little bit of ATO guidance around deductions for obsolete stock. So it pays to look through this to see whether some of those deductions are available. The other thing worth considering in relation to your trading stock is the valuation methodology. The ATO allows 3 different valuation the legislation actually allows the 3 different valuation methodologies, and each of them may give you a different tax result. So it might be worthwhile playing around to see whether one gives a better result. It might be that you wish to bring income into this year. I know that some sort of businesses have struggled a little bit this year. So if you foresee a lower income this year and higher next year, it might be that you want to bring some of that forward. Scrapping assets and a review of your fixed asset registers more generally, although this is a little bit less of an issue now, given we've had a few years now of the temporary full expensing, and a lot of fixed asset registers are sort of getting close to written off. Still, to the extent that you have older assets, it's definitely worthwhile looking into. Bad debts. Again, you're only allowed a deduction for a bad debt where it's fully written off. So simply providing for the debt in your accounts won't allow a deduction. So where you have debts where you have virtually no chance of recovering and you don't intend to continue chasing, if you do fully write them off in your accounts, you will get a deduction for them in the current year. And it may also allow you to claim back GST on that revenue to the extent that you've paid it to the ATO already. Prepayments, the ability to claim deductions on prepayments is limited based on your size. For groups with turnover below 50 million, this will allow you to bring some deductions forward, but keep in mind, however, that it's one-off benefit and it's timing only. You're just moving the deductions between years. The other possibility is to look at accruing for expenses that relate to the 30 June year. So, for example, your electricity bills or bills that might not have been received yet for major work performed during the 30 June year. Again, however, that's a one-off timing benefit, but it's certainly worthwhile if you foresee less profitable years in future. Keep in mind also that there's no loss carryback available anymore. That measure, which came out of COVID, ended in the 23 year. Just down there, a reminder for professional services businesses. So that's any professional services, including engineers, lawyers, doctors, vets, accountants as well, of the ATO's guidance on the profit allocation. So this guidance has been in place for a few years now, and it essentially sets out what the ATO considers as risky sort of income splitting on those arrangements. So where you have those types of businesses, definitely need to be aware of that guidance. Finally, just a few points particular to primary producers. And I know, again, it's been quite tough for many, but there are a few concessions available if you are looking to bring your income down for the year, particularly immediate expensing of the certain assets, so fodder storage, fencing, those types of things. Just a reminder, if you have withdrawn a farm management deposit during the year, that will be assessable in the current year. Income averaging is still available, so it's worthwhile having a discussion around this if it's going to provide you some benefits. There are also provisions which allow the spreading of profit on forced livestock disposals, as this again has probably impacted many producers this year. The other one, which I'll quickly mention, which isn't up on the slide, is where businesses have generated carbon credits, or you've sold the carbon credits during the year. As with trading stock, there are a few different methodologies for valuing the closing balance of your carbon credits. So again, there might be some flexibility there to move income between years. Finally, I've just got a note there on the slide around benchmarking emissions. I know it's not directly related to tax, however, it's becoming increasingly visible because the larger corporates now will have mandatory emissions reporting coming online in the next few years. So any business involved in the supply chain of those groups will be impacted. It most certainly impacts primary producers, but other businesses as well. Just, I guess, a reminder that the sooner you benchmark your carbon, the better, particularly if you're planning initiatives going forward that are going to reduce that. In the absence of that baseline benchmark, you're not going to gain the benefit of the emissions reduction work that you do over the next year or so until you get that baseline benchmark. So certainly the sooner the better that you get that, it will definitely help in your reporting under those obligations. Division 7A, of course, always comes up at the year end and applies to payments by a company to a shareholder or associate. A reminder that it covers any sort of payment. It includes loans and also the use of company assets and property. You'll see there that there's a large increase in the rate this year for compliant loans. It's gone up from 4.77 up to 8.27. So certainly when you're doing those income on the loan calculations, there'll be a larger amount of income needing to go into the company. One point to note is that the legislation does actually give the Commissioner the ability to disregard a deemed dividend where certain criteria are met. And this year, the ATO has brought out some guidance around its application of the discretion, although generally sort of toning down expectations that it would be available. It does note that it can only apply in certain circumstances. Most of them relate to where there's been an honest or inadvertent omission. But the ATO has flagged that they're going to be less willing to apply that discretion where the taxpayer hasn't taken advice on Division 7A. And they also said quite explicitly in their top 500 and next 5,000 reports that where taxpayers had the resources to obtain proper advice on Div 7A, then they were quite unlikely to exercise the discretion at all. So certainly if you're a taxpayer which is increasing in size and resources, the ATO will be less inclined to help you out there. I've just listed up there some of the common mistakes that keep coming to the ATO's attention in relation to Division 7A. So they include repaying the amount and then sort of immediately reborrowing. The non-compliant loan documentation is a big one, and also interposed entities with unpaid present entitlements. I'll briefly mention Bendel's case, although I note that the ATO is appealing the decision, so we watch this space for the moment. As you may know, the ATO has for quite some time now treated unpaid present entitlements from a trust to a company as a loan and required that they be put on complying terms and that interest be paid and so forth. In Bendel, the taxpayer challenged that view and the tribunal actually agreed with them that the amount is not a loan. So this will obviously have quite significant impact for a lot of taxpayers and generally positive impacts too. Although, as mentioned, the decision is currently being being appealed by the ATO. So we will need to wait until the result of that appeal before taking any further action. Finally, just moving on to a few reminders around trust distributions. The first point here is just to make sure it meets with the deed. So get the deed out, pull it out, check the purpose, particularly given the decision in EOFY, which I'll move on to next. But really the deed is the beginning place for any trust distribution. The distributions need to be made on or before 30 June, although the documentation can occur at a later date if there's more than one trustee or director. Just quickly, the decision in EOFY's case, and just bear with me for a moment while I discuss it, because some of the implications are relevant for all trustees of discretionary trusts as you make your distributions. And the facts here were quite extreme. The relevant trust was a family trust, and importantly, it has had as the object of the trust providing for the primary beneficiaries, all of whom were named and were mum, dad, and their 3 adult children. There'd been quite a severe breakdown in the family relationship to the point that no contact between the parents and 2 of the children was made for a period of around 10 years or so. And during that time, all of the distributions went to mum, dad, and 1 of the children. And the 2 estranged children received nothing. And the key issue on appeal there was whether the trustee had obtained sufficient knowledge of the circumstances of the 2 estranged children to appropriately exercise its discretion, particularly given the period of estrangement where there'd been 10 years where the trustees really knew nothing about what was going on in the lives of these beneficiaries. And also that the financial circumstances of 1 of the beneficiaries in particular was quite dire at that time. The court actually found in favour of the 2 children and that the trustees hadn't properly exercised its discretion and hadn't properly considered them, even though the trustee had an unfettered discretion to distribute to whoever they wanted to. Really key to the court's decision was that the trust was established to make provision for the primary beneficiaries, and the court was satisfied that the trustee hadn't taken steps to inform themselves of the circumstances of each of those beneficiaries when making the distributions. The decision itself contains a lot of information around the exercise of the discretion, but just some of the key takeaways from that. I think the importance of understanding the purpose of the trust, which needs to inform any decision making. So I guess it goes back to that point that I originally made around having a look at the trust distribution and understanding what the purpose of the trust is. If you are a trustee, you do need to turn your mind to the exercise of the power. So while it might be that your trust distributions are similar year on year, I would certainly urge against cut and paste distributions, statements where you just sort of bring forward what you did last year. Certainly in the EOFY's decision, the court cited that as really strong evidence that the trustee hadn't considered all the trustees, and definitely it was a supporting factor in the way that it decided. Similarly, if there are multiple trustees, certainly actually holding a meeting to evidence the due consideration would be helpful. There's no obligation to provide the reasons for the distribution, and certainly I wouldn't suggest against doing that because that can cause other issues. But the trustee needs to be at least informed of the circumstances of the beneficiaries. So where your trustee has quite wide beneficiary classes, just be aware of that. In theory, you need to consider each of them. And the final point that the court made was that the trustee power is separate to the role of the parent. So what's going on in your family life cannot impact your decision as a trustee of a trust. The other key point to note out of the decision was just around the establishment of new trusts. So to be mindful that if there's a wider class of beneficiaries, then obviously you're going to need to consider all of those people individually when you're making your distributions. And the final point there I have is around whether you may wish to speak with your advisor around a trustee assessment. Unless the trustee itself lodges a return, technically it has an unlimited amendment period going forward. You only start the clock on your 4-year amendment period if you actually lodge a return, which means that if there's a future review by the ATO, technically they can go right back sort of to an unlimited time. So lodging an assessment, bringing a small amount of income through to the trustee, at least starts your clock on that period. So it might be something that you want to consider if you have a trustee of a trust that, you know, may be in the future reviewed. Just finally, some of the key dates leading up to 30 June. Obviously, 30 June, drop dead date for your trustee resolutions, single touch payroll by 14th of July, and then the payroll tax returns and TFM reporting due by 28th of July. The one thing that's also due on 28th of July, which isn't up there, is the super contributions, if not paid before the end of June. And I will use that as a segue to hand over to Lauren, who's going to provide an update on the superannuation. And once again, I thank you for your time this morning. Hopefully you found something useful out of it. Thank you.
Great, thanks, Belinda. Hi, everybody, and sorry for not being Katie, but hopefully I'll be just as good. And she is there in the questions. If you do have a question, please put it in the Q&A and she will answer them, I'm sure. So just give me a moment to share my screen. Okay, I'm hoping that's all working. We'll get started. We'll start with end of financial year planning for superannuation. The big thing to remember is for contributions. So Belinda just talked about the due date for mandated employer contributions, but you also want to be mindful of if you're planning to make any personal contributions or salary sacrifice contributions, for them to count for this current financial year, they need to be received by the super fund by the end of the month. So if you have a self-managed super fund, they need to hit the super fund's bank account by the end of the month. And remembering that this year, the 30th of June falls on a Sunday. So you should pretend that the end of the financial year is the 28th of June, just to make sure you get that in time. The cap for this year is $27,500. So that's been the cap for the last few years. It is going to go up on 1 July. So if you have had mandated employer contributions and you want to top yourself up, you should be able to log onto your MyGov or talk to your accountant to see how much room you have left to play with. But that's the cap for this year. If you're over 67, you do need to be mindful that you need to pass what they call the work test to be able to make personal deductible contributions to super. The work test requires you to work at least 40 hours over a 30-day period at some point during the year. If you've passed that test, if you're over 67 and still working, then you are eligible to claim a deduction for your personal contributions up to your cap. You may also have the option to claim more than your annual cap if you've got less than $500,000 in your superannuation fund. The testing for that is to look at how much you had in super at 30 June last year. And again, that's something your accountant can tell you, or you can go onto MyGov. If you had less than $500,000 across all of your superannuation funds, that includes anything in pension phase, then you can claw back and claim any of your unused caps from the last 5 financial years. We've also got the other side of contributions, which is called the non-concessional contributions. Some people also refer to them as after-tax contributions. There's no tax deduction for those. They're just extra contributions that you can put in to build up your superannuation balance. Again, those also depend on how much you have in super. I won't drill down on the detail because I'll get all jumbled up, but Katie's put the table there on the slide. So essentially you could do up to 3 years worth of non-concessional contributions if you've got less than $1.68 million, and then it caps out if you've got more than $1.9 million, you can't do any non-concessional contributions. That is limited on age as well, up to the age of 75. So if you are close to that age, just double check that you're still eligible to do that. Other things to remember before the end of the financial year. So if you're drawing down a pension, the same thing to remember, pretend that the end of the month is the 28th of June and make sure you've taken that cash out of the bank account by then. If you don't take your pension, the super fund will pay more tax because it loses its eligibility for tax concessions. So it's very important that the minimum pension is paid. If you're not sure if you've got a self-managed super fund or a public super fund, check with them and make sure that you've covered on your minimum. Other things to remember if you have a self-managed super fund, like Belinda was talking about, the ATO really care about related party arrangements. So if you've got a property leased to a related party in your super fund, make sure your rent is up to date. By 30 June, make sure that you've got a current lease agreement on file and that you're complying with the lease agreement. Check whether you needed to do a rent review. You might be underpaying rent if you haven't increased the rent in line with that review. Or your lease agreement might have expired if you're not on top of it. And that's the first thing that your auditor is going to check that you're complying with the arm's length rules. Lastly, if you also have a self-managed super fund, check whether you might need to get new valuations for your assets, particularly for property. That's a big focus area for the ATO. And then for the auditors, they love looking at properties, making sure they're up to date because the value of your super fund is linked to so many different things. You need to make sure you've got current valuations on file. So what's new? So yes, the caps for contributions are going up on 1 July. The concessional cap's increasing to $30,000 and the non-concessional cap is 4 times that at $120,000. That flows on to the obviously being able to bring forward your caps from the next 2 years for your non-concessionals. And the super guarantee rate is going up as well to 11.5% to build up to that 12% rate. So what's new in superannuation? We had the budget. It was fairly quiet on the superannuation side of things. The main 2 announcements were that they are going to pay superannuation on paid parental leave. That starts 1 July 2025 for children born or adopted after that date. People who are getting paid parental leave from the government will get a super guarantee to their super fund as well. And then from 1 July 2026, they've put in that superannuation for your employer contributions are going to be paid to your super fund with every pay cycle as opposed to quarterly as it is now. So what's coming? This is the probably the biggest thing in my world at the moment, which I don't know what that says about my life, but so Division 296 tax. For those who don't read super legislation, that is the tax that's they're going to put in on people who have more than $3 million in superannuation. So it's currently still with Parliament. It hasn't technically gone through yet, but it is expected to go through. And it will start 1 July 2025. And people who have more than $3 million in super will be taxed on the earnings in their super fund above that amount. So it's not a simple law. It's quite complex, and I'm going to do my best to talk you through it. And I might jump to the next slide. So how it actually works, what they will do is look at how much your superannuation has grown over the last 12 months. So if it starts 1 July 25, they'll look at the growth to 30 June 2026. They'll make adjustments for if you've made contributions to the fund, they'll take that out of it. But if you've taken money out of the fund, they'll add that back on like you haven't done it. So they're just looking at, essentially they're trying to get to how much have the assets grown in value over those 12 months. They'll take a proportion of that growth and apply a tax to it. So based on how high you go over the $3 million, and that proportionate growth will be taxed at 15%. So Katie's written an actual example here. So Lisa had a closing balance of $4.5 million, and she started the year with $3.3 million, and she didn't make any pensions or contributions, so we don't have to adjust for that. So our earnings calculation is simple. We just look at the difference between 4.5 million minus the 3.3 that she started with. Then they look at the proportion of the earnings that apply to the excess above $3 million, and Katie's worked that out as 1/3, so 33 1/3 of the 1.2 million worth of growth is applicable to that excess amount. And that is the excess amount that's taxable at 15%. So the growth is $1.2 million and the tax works out to $60,000. So I guess the takeaway here is that it's not just a flat 15% tax if you've got more than $3 million in super, it's a proportionate amount of that, and depends on the growth overall in the fund. So the finer details, it's due to commence on 1 July 2025. At this stage, it's not going to be indexed. So somebody who's in their 40s will still potentially have this tax apply to them, even if inflation means their super grows and is worth a lot more than it would be. The $3 million would still be the rate that they're hit with the tax at. The negative earnings, if your super drops in value, it's going to be treated like a capital loss, so you don't get the money back if you've lost value in your super fund. And it is a personal tax. So like, I don't know how many people have this, but a Division 293 tax where you're taxed, if you're a high income earner, you pay an additional tax on your contributions. It's the same as that. So it's a personal tax, but you'll have the option to take it out of your super fund if you want to. But otherwise, you're personally liable. And lastly, that if you receive benefits from your spouse because they pass away, that will be treated like a contribution to your super. So you won't be taxed on that growth in your value, but it will count in your total super balance when we get to the next financial year. So it will be a factor down the track. So I guess that's a big red flag for people who think it doesn't apply to them. If they were to receive their spouse's superannuation, their superannuation doubles and they're suddenly part of this fund new world. So where are we at with it? So yeah, like I said, it's still with Parliament. It's not currently passed. It did go to a Senate inquiry and they rejected all submissions that were made, particularly in regards to how it's going to tax people on unrealised growth in value of their assets. The Senate found that it was still an equitable tax. I won't go into the details, but yeah, basically no changes were made to what was proposed last year. The government want to have it passed by the end of this month to give people 12 months to plan ahead. The Greens have made some demands to support before they support it. But for right now, it's still in Parliament. At the moment, we're advising you not to take any action right now, given it's not actually law. We expect it will be in place in the next few weeks and 12 months to plan ahead. So once that's ahead, I'm sure we'll be doing a lot more webinars on it. And of course, always reach out to your accountant if you are concerned about it. Okay, time for some questions.
Thank you for that, Lauren and Belinda. And we'll just give everyone a moment to see if there's any other questions and use the questions or the chat panel to submit those if you have, while we have both Belinda and Lauren online. While we're waiting for some of these to come through, Lauren, if we can just go to the next slide, we'll just provide some details on our next webinar in the series. So what you can easily do is actually click on the QR code if you have access to your mobile device and register directly. Or we'll also provide a link to the registration page for this webinar in our series in the follow-up email that we'll be sending out. So the next session in the Business Essentials webinar series will be focused focused on cybersecurity for SMEs. Very relevant topic for the audience, and we're going to be holding that on the 30th of July. Just see if we've got any questions coming through. Okay, I can see we've had one question's come through and Katie's already responding to that one directly, I believe. Lauren, not sure if you wanted to add to it.
I'll just stop sharing my screen now so I can see it. Okay, so the question is, the tax on unrealised gains was allegedly dependent on the next election. Katie's answered the legislation is actually due to pass before the next election, and the government has announced that if the public doesn't want it, then they can vote them out. So yes, we're expecting it to come through in the next few weeks, so before the next election.
Okay, we've got a couple of thank yous coming through. Also, one under the 296, can losses be carried forward?
I'll take that on notice. Katie's typing an answer. Yes, I don't know the detail. They can, but it's complicated. Katie will answer you, Mr. Pridmore.
Maybe just while Katie's answering, there's one that's come through just around some more details on the concessions for forced livestock disposal. So what those concessions do, and it depends on sort of, if you're forced to dispose of livestock because of drought, flood, those types of things, they allow you to take the proceeds of disposal and spread them over the next 5 years. Anything that you haven't returned within 5 years needs to be included in the income in the 5th year. So it's just a measure that allows you to sort of, rather than paying tax on the full amount in the first year, it just allows you to spread that amount. Hopefully that answers that.
Yep, and Katie's just answered about the carry forward losses. Yes, but simpler than my answer.
Wonderful. We'll just give everyone one last moment to see if they have any last minute questions to submit to our presenters today.
Okay, so I'm just reading, if I have to pay capital gains tax on the increase in value of my super entitlement above $3 million, and there is a subsequent significant drop in value which is not recovered before I retire, what happens to my capital loss? So the super fund would pay capital gains tax on the disposal of the asset. The rules around capital gains tax for the super fund aren't changing. So if you're in pension phase, you'll get either a full or partial exemption. I can see Katie's typing an answer. So the capital gains tax rules aren't changing. If you make a capital loss, you still carry it forward to apply to future capital gains. But you can't apply that capital loss to the losses that relate to Division 296 tax. I'm hoping that Katie's answer matches that, but I will let her keep typing and move on to the next one. If there were back payments of concessional super guarantee made into the 2024 year, but they're related to periods, are they included? Yes, so the contribution counts towards your cap in the year that it is received by the fund. So even if they relate to work performed to a prior year, they will still count towards this year's cap. The only exemption would be if the employer made a mistake and didn't pay contributions, just paid them late. The person who received the contributions can apply to the ATO to have the excess contributions assessment disregarded as a special case because their employer failed to meet their obligations. But you have to apply to the ATO for that.
Okay, well, we might wrap it up there just in the interest of time. What we will also do in our follow-up email was we'll provide the contact details for Katie, Lauren and Belinda. So if there are any other questions that you require any answers to, feel free to either reach out to one of them or your RSM advisor, and they'll be able to assist. So on that note, thank you very much for joining us today, and we really hope you found the session of value. I would also like to thank our presenters again, Belinda and Lauren, and also Katie for your time in sharing their knowledge and expertise. As I mentioned earlier, we had the slide up with the link to our upcoming session for the Business Essentials series, focusing on cybersecurity. So we hope you're able to join us for that session, and we'll include a link to that in the email, which you will receive shortly, with also a link to the feedback webinar survey. Thank you again, and we hope you enjoy the rest of your day.
Thank you.